right, guys. Jason with Direct Credit Funding, back for another episode of Direct Credit Funding with Jason. What I want to talk about this week are common questions that we get here. We've been doing this 28 years now, so I've been doing this a long time. And here's some of the questions that we get all the time that I want to discuss with folks. Number one is how much money do customers need to put down? We do 100% financing. So that's the huge good news is we offer 100% financing. Normally we're going to collect one payment at signing, but sometimes it's just a documentation fee at signing. And that's really pretty much regardless of the dollar size of the deal, whether you need $10,000 or $2 million. It really doesn't matter to us. We are generally going to loan 100% of your equipment cost to you. If it's a special credit situation, we might get some money down, but I will tell you 99% of the deals that we fund here are done with 100% financing. Next question we get is how long of terms do we offer? That one's pretty basic. It's anywhere from 24 months to 60 months. However, we do have a couple of specialty programs that will lend out to 72 and 84 months. So we do anywhere 2, 3, 4, 5, 6, 7 year terms now. So that's a huge win for us. Early payoff. That actually is a big one that we get all the time of what is our early payoff guidelines. And we do offer what's called a 5-4-3-2-1. So in traditional equipment financing, and it has been for years and years and years, this is a dirty little secret in the industry, is the contracts are built what's called non-cancelable. So you as the borrower have these agreements, and still a majority of the agreements out there are what's called non-cancelable agreements, and that means that you are paying the sum of the remaining payments. You are 2 years into your contract on a 5-year contract, and you say, "Hey, I want to pay this off early. We've got a bunch of money," and you call for a payoff, and suddenly you find out that it's the sum of the remaining payments, and that you have 36 remaining payments of the full payment, and it causes a lot of friction. And that's been something that we are very cognizant of here at my company, and we have developed a different program, and it's called a 5-4-3-2-1, which is much more advantageous to you as the borrower. And what that means is we take the principal balance in the first year of your contract, you take the principal balance of your contract, and then add 5% to that, and that's your payoff amount. In the second year, it's the remaining balance on your contract with a 4% penalty. Year 3, remaining balance with a 3% penalty. Year 4, remaining balance with a 2% penalty. Year 5, remaining balance with a 1% penalty. And the reason that the lenders do this non-cancelable agreement is the banks want to park their money for as long as possible. That's just, they want to put the money out on the street for as long as possible, and they like to budget and account, and that's why they have these non-cancelable agreements. With this new 5-4-3-2-1, which is relatively new in our industry, and it's something you just need to be aware of, ask for. It's standard on most of our contracts, but that's under the early payoff guidelines. So get with our team on the details of that, but you as a borrower, you want to get that 5-4-3-2-1 as opposed to the non-cancelable contract that most lending partners have built into their contracts. So that's a common question. What's the end of lease purchase option? We've talked about it in one of our prior episodes, the difference between a lease and a loan, or a lease or an equipment finance agreement. We are structuring our loans with, if it's a lease, we're generally going to do with a dollar buyout so that you are the owner of the equipment at the end of the term if you're wanting a lease product. There are occasions where you might want to structure it with a balloon at the end, and that's one of our, like I said, what's your end of lease purchase option? Ideally, we want you to own the equipment at the end of term, so we would structure it ideally as a loan under the equipment finance agreement product, so that you are just the automatic owner of the equipment at end of term. If we do structure it as a lease, we would structure that ideally as a dollar purchase option, unless there is some reason that it needs to be structured with a fair market value with a term residual, which means that you would own it either with a fair market value at end of term, which ideally is not something that you as a borrower want. You want to have a fixed residual at the end of the term of the lease, either a 10% or a 15% or 20% end of lease residual. So those are common questions. Another common question is, do I need to purchase from a vendor? Yeah, you do. Ideally, you do need to purchase from a vendor. If you're purchasing from a private party, it needs to be a titled piece of equipment to make the title transfer much easier. Can we do non-titled pieces of equipment through a private party? Yes, but God damn it, those are hard. There's a lot that goes into that. Let's just talk about it. It is what it is. There's full steps, and you may find this interesting, you may not. But if you were going to purchase a non-titled piece of equipment from another, what we call another private party, which means a non-vendor, they are going to have to prove ownership of the equipment, that they bought the equipment and paid for the equipment whenever they bought for the equipment. We're going to have to value check that equipment to make sure that you're not overpaying for the equipment. And then we're going to do a UCC search on the seller of the equipment to make sure that they don't have any outstanding liens. We're going to have to do a site inspection to make sure the equipment's there and tangible. There's just a lot of steps to go through that really make that hard. Doesn't mean it's impossible to do, but it's going to be in a limited circumstance. It's going to be on harder assets such as construction equipment, things of that nature. We're not going to do it on office equipment or quote unquote soft collateral. Buy from a vendor. That's my number one advice across all these videos. Buy it from a vendor, distributor that sells the equipment. So yes, the short answer is yes, you need to buy from a vendor. Age of equipment. We get that question all the time. Do I have to buy new equipment? Can I buy used equipment? Can I buy older used equipment? Yes. The answer is yes to all that. A lot of financial institutions are only looking to lend on equipment that is 10 years or newer. I am okay lending on equipment. I don't have an age limit on the age of equipment. We recently funded a 2001 truck for somebody. We also funded a 1991 piece of equipment for someone. We're not afraid to fund older equipment as long as it makes sense. Do I need to provide tax returns? No. 90% of the business that comes in our door here at Direct Credit Funding, we do not look at their tax returns. Now that is going to be true for deals under $500,000. For deals over $500,000, yes, we're going to want to see some tax returns. We're going to want to understand your business more. We're going to take a deeper dive. But with that being said, that just because your request is over $500,000 and your tax returns show losses doesn't mean we still won't get you approved. There's a lot of creative financing opportunities in that $3 to $1 million space that most banks and financial institutions would ask for tax returns, that we can come up with some creative solutions for you to not look at your tax returns and still get the financing that you need. So that's where talking to one of our consultants here, letting us know what's going on and helping us understand the nature of your request, we can still fit you without tax returns. Another common question is, can we work with prior bankruptcy? Absolutely, yes. I'm looking for you to looking for the bankruptcy to be 3 years or older, and I'm looking for it to have reestablished credit. Those are the two caveats. 3 years out of bankruptcy, reestablished credit. If you've got reestablished credit, happy to do business with you, happy to extend more credit to you. We've understand something that's traumatic has happened in your life. You've overcome it. You've shown good faith. Happy to work with you on that. So prior bankruptcies are okay. Tax liens. Tax liens are common. Tax liens do not automatically disqualify you. If they're paid, obviously that's great. If they are on a payment plan, I'm okay to work with a tax lien. Not every lender will consider that, but if you're on a tax lien, I can do that. Hawaii and Alaska, we're okay with Hawaii and Alaska. Just had one the other day for Puerto Rico. That's something not everybody does. Puerto Rico, we can do lending in Puerto Rico. Other common question, do we offer corp-only lending? Absolutely, we offer corp-only lending. Generally going to be for a company that's been around for 5 years in business, and generally made for a company that has 5 or more owners. Doesn't mean if they have less than 5 owners that I can't do it, but corp-only lending is available if your business has been around for the appropriate time and if you have the credit history to support corp-only lending. But that gets me to an aside note is, do all owners need to personally guarantee the loan? It's a trick question. Not necessarily. We prior discussed this in one of the prior videos. In an ideal world, I am looking for everyone over 20% to be on the contract. However, I can accept in certain circumstances 51% ownership. So that's just something different that we offer that not every lender offers out there is we can lend you, we can only have 51% ownership sign on the contract. Will a cosigner help? Yes. Cosigners will help. If now a cosigner is not here to make up for shitty credit or extremely bad credit. They're here to make up for limited credit. If you have limited borrowing capacity in the past, a cosigner will help make up for lack of credit or light credit. It doesn't make up for if you've got a 450 or really poor, bad credit and you've never paid a bill on time in your life and mom and dad are willing to sign for you. That is not what a cosigner is for. A cosigner is for, hey, I'm new in business. I have, and I'm younger. I have lighter credit, but I've got a partner here that works. I've got my main guy here in the business. He's not an owner, but he's willing to sign on the line with me, and he's got good credit. Absolutely, that puts a deal together that otherwise wouldn't be put together. So a cosigner is definitely available to help put a transaction together that wouldn't normally get put together. Okay, looks like we've had a good episode. I'm sure we'll cover more topics in the next one. Thanks for watching. Please hit the like and subscribe buttons, and we'll see you on the next episode.